History has suggested the odds are against 2023 being another bad year for stocks. Today, we'll be letting you know the bad stocks. Heading to 2023, inflation seems to be finally subsiding. However, economists and analysts are so much concerned about the Federal Reserve's battles with rising prices that are still far from over, and a recession could be on the menu in the first half of the year. Interest and inflation rates will likely remain Wall Street's two primary concerns in the first quarter of 2023. The bond market is pricing in at 86% chance, and the Fed raised rates by at least another 50 bps by March 2023, according to CME Group. In 2023, the first few months will likely be a very critical period for the economy. While inflation appears to be trending downward, economists and analysts are concerned it may prove stickier than the market is expecting. Up to this point, the Fed has aggressively raised the rate without tipping the economy into a recession. However, a recent economic data report suggests the risk of a recession in early 2023 has risen significantly. Investors concerned about recession risk can take the advantage of rising interest rates by reducing exposure to stock and increasing their cash holdings. 4% interest on top high-yield savings accounts from banks that are insured by the Federal Deposit Insurance Corporation, or FDIC. It's what the investor already earned, and those rates are likely to increase in early 2023. So lots of investors suffered a bit in 2022, with three major indices making their biggest decline since the 2008 financial crisis. The tech-heavy Nasdaq Composite endured an ugly fall of more than 33%, while the S&P 500 sank 19.5% also. The Dow Jones Industrial Average fared the best, down 8.8% thanks to its relative underexposure to badly beaten technology. Several factors drove the heavy pullback. Inflation and the Russian invasion of Ukraine dealt a devastating blow to the equity market. The Federal Reserve then pivoted from its stance that inflation was transitory and began aggressively rising the rate in an attempt to beat down prices. This effort now appears to be bearing fruit, but only after hammering down the market price. For the records, these aren't the New York Stock Exchange's very biggest losers of 2022. We'll exclude small caps and micro caps are eligible investment prospects simply because these stocks pose more risk than most investors should take on. Evaluating just the inevitable large caps and mid caps, 2022 big NYSE laggards are Twilio with negative 2.68%, Wayfair with negative 1.92%, and Asana with 0.97%. Asana and Twilio fell a little more than 81% last year, while Wayfair lost nearly 83% of its value. Same as all reflecting as a bad stock this year, 2023. It's not too difficult to figure out what went wrong. Take Wayfair as an example. Economic weakness tends to decrease optional spending first and foremost, leaving the online retailer of home goods particularly vulnerable to the environment. To this end, the company missed its revenue and earnings estimates with last February's report of its 2021 fourth quarter results, kicking off a string of similar shortfalls later in the year. Indeed, sales are down 13% through the first three quarters of 2022, prompting a major swing out of the black and into the red. Shareholders have always had to give them up-and-comers lot of wiggle room, but last year's results are proving a major test of tiger patience. Twilio shares tumbled for relative purposes, which is a disappointing result. While it started the year on the right foot, the customer communication platform missed the second quarter and third quarter outlooks and further undermined its stick value with lackluster Q4 guidelines. The company's expectation for revenue growth of between 18% and 20% is not only below analyst forecast but also suggests slowing growth. As for Asana, it could come as no surprise that it is suffering from a reel of earnings shortfalls and tepid guidance. The only difference? It started 2022 on the defensive. The management software name warned shareholders in a match that it would be booking bigger than expected losses for the first quarter of the year despite better than expected revenue for the period. The dynamic didn't change throughout the remainder of the year either, as losses are still expanding in step with revenue growth. The question remains, however, did the sellers overshoot their targets, making these names juicy buys as a result? No. A tough truth, although it's tempting to be certain. Most veteran investors and even the upcoming ones have seen the market overreact to headlines only to unwind the mistake shortly thereafter. Certainly, many of the last year's bigger losers will end this current year much higher. In the scenario of Asana, Twilio and Wayfair though, such a recovery might not be in the cards this year, because it's the worst stock you could think of this year or ever. It may be a somewhat quite unpopular point to make within some investor circles. In many ways, the steep sell-offs in question ultimately reflect a reckoning of sorts. Investors were helpful to these companies immediately before, during, and even as the worst effects of the COVID-19 pandemic greatly eased. In retrospect though, it's becoming clear these establishments may never be able to live up to the hype, even under the best of circumstances. Take for example Twilio's core SMS technology. It's already being challenged as obsolete. Jefferies analyst Samad Samana wrote in November, Twilio successfully auctioned the software solutions to its portfolio has been a significant factor of our thesis that has not materialized. RBC capital market analyst Rishi Jaluria downgraded Asana in the middle of last year because the firm cannot undergo a substantial market opportunity for Asana. While Asana buyers have spoken to like the product but believe the space is extensively applicable outside tech companies, it's not viewed as a substantial business model. Investors extremely believe in RBC's stated concerns. All these are going on at a time when productive tech titans like Microsoft and Alphabet are cutting costs. If these powerhouses are bracing for something worse, smaller players like Twilio and Asana are certainly on the edge of crisis. In these cases, a stock's steep sell-off is not inherently a purchasing opportunity. These big-time routes are the very warning they look like they are. If you're in search of deeply discounted bargains here, just make sure their underlying businesses are built to thrive. Not every company is built to do so in every environment. The worst mistake investors will make this year won't be getting caught with the stock on the heels of a disappointing earnings report. With all due respect to economic prognosticators, it won't be misjudging the Federal Reserve's resolve in fighting inflation or the risk of a recession as the central bank pushes up interest rates at the fastest pace since the 1980s. The odds of another big stock market slide are growing. Raising interest rates to reduce demand is a time-tested way to bring down inflation near term. But voting court also reduces investment. When the Fed eases up, supply lags even further behind demand, driving prices higher still and worsening inflation. For instance, from July 1967 through August 1969, the Fed raised the bar rates from 3.79% to 9.19%. From July 1971 to July 1974, it helped shove the economy into a deep recession by pushing rates from 4 to 13%. From August 1977 through May 1981, the Volcker Fed boosted rates from 4.75 to 20%, nearly triggering a global recession. The combination of consistent pro-investment fiscal and monetary policy, as well as the emergence of China as a low-cost manufacturer, eventually shut down the supply and demand halt and ended the inflation of the 1960s through the 90s. The famous investment media is now loaded with stories about investors who are postponing retirement because of losses sustained in 2022. Unfortunately, those banking on index ETFs to make them whole in 2023 will likely feel a lot more distress. Whether your objective is income, wealth building or speculations, Roy's got to take control of your finance to avoid a big loss. That's not as easy as just buying an ETF, but by making a huge effort, you can build a real wealth in the coming inflationary periods, even as the typical investor look over their savings slip and slide away. Let's know your thoughts in the comments section. Also, be sure to subscribe and put on your notification bell. Get more informative and interesting video here. Well, did you like the video? Now check this out.